So, episode 18. So, in the past episodes, we have enumerated the possible measurement questions, related of course to the accounting of the loans payable. And we tried to answer those questions also based on an illustrative problem. So, in this video, we're going to answer again those questions. But we are going to use the amortization table to get the amounts instead of the timeline technique. And as I have told you, many authors prefer this type of solution. Okay? But before you proceed with this video, you need to visit all the previous episodes to maximize your learning. The links of the previous episodes are on the description below. And if you're done already, then let's get started. So, let's start this video lecture with our completed timeline in the past episode. Okay? So, now let's compare it with the amortization table. So, let's make one. Okay? So, in order to make the amortization table, we will need to fill up these columns. So, we have the beginning balance of the loans, and then we have the interest expense columns, and the third column is for the interest payment agreed, and the fourth column is for the discount amortized, and we also have a column for agreed principal payments, and lastly, the ending balance column. Okay? So let's start filling this up. So let's start with year 1. So the beginning balance is 4,657,835 as given in the problem. But then again, if it's not given, then the process of getting this amount is actually the same with what I explained in the past episode, which is again, principal minus charges or transaction costs. And if they are not available, the principal and the transaction costs, so we will have to get the present value of the future payments. So we're going to get the future payments times the present value factor of 1, or present value factor of 1 ordinary annuity, or present value of 1 annuity due. So whichever is more applicable. Okay? So basically, the process is the same even if we use the timeline or the amortization table. Okay? Now, let's go to the second column. The interest expense is actually this beginning balance or this beginning carrying amount times the effective rate, which is 13% as given in the sample problem, right? But then again, let me remind you that if the effective rate is not given, then you will need to do the trial and error and interpolation. Okay? So, 4,657,835 times 0.13 or 13% equals 605,519. So, now, the interest payment column is the interest of 10% nominal rate based on the undiscounted or not discounted outstanding principal balance. So, the undiscounted outstanding balance in year 1 is of course 5 million. Although, the balance will be deducted by 1 million each year, right? So, that's based on our sample problem. And since, again, we are still on year 1, so 5 million times 10% is 500,000. So, we need to put that here, okay? So, next column. The difference of these two, this effective interest expense and the agreed interest payment, is actually the discount amortized. Okay? Now, in order to get the ending balance, you can have the beginning balance plus the interest expense minus these payments of 500,000 and 1 million. And you will get 3,763,354. So that's option 1. Or you can have the option 2, which is you can immediately add this discount amortized to the beginning balance and then deduct from it the principal payment, and you will still get 3,763,354. Okay? So now, this ending balance in year 1 will become the beginning balance for year 2. So let's copy this to here. Okay? So let's continue filling up the year 2 to year 5 after this. So again, the balance at the end of year 1 will be the beginning balance for year 2. So let's multiply this by 13% in order to get the second column, which is again that 13% is the effective rate. And we will have 489,236. And then the third column, the agreed interest payment, will now be 10% nominal rate times 4 million. And we will have 400,000. And again, the difference of the actual interest expense or the effective interest expense and this agreed interest payment is again the discount amortized. And then the next column is the agreed principal payment, which is still 1 million. Now, to get the ending balance in year 2, we have 3,763,354 plus the discount amortized of 89,236 minus 1 million equals 2,852,519. And I did that second option to fill up this table faster. Okay? So let's copy this amount to here. And then, let's multiply this balance again by 13% to get the interest expense of 370,836. And then, we have here 10% times 3 million, which is 300,000. And we will put that here. And since the interest expense again is greater by 70,836 versus the interest paid, then it should be registered as the discount amortized. Okay? You need to remember that. Again, you need to remember that if the interest expense is greater than the agreed interest payment, the difference is the discount amortized. Okay? And in addition, it should be added to the beginning balance before deducting the principal payment agreed if there is, because most of the time the principal payment is made only once at the end of the maturity period. And if you do that, then you will get the ending balance immediately. Sir, somebody might ask, but what if it's reversed? Meaning, what if the interest payment agreed is greater than this interest expense? So, if that happens, the difference will be called premium amortized. And that will only happen if the proceeds received by the debtor is actually greater than the principal that he or she has to pay in the future. But, I'll tell you guys, the premium normally happens when we talk about accounting for bonds payable or investment in bonds in the next episodes. So, for now, let's stick to the discount amortization. Okay? So, where were we? So, we have here 1 million as the agreed principal payment still. So, 2,852,590 plus the discount amortization of 70,836 minus 1 million, and we will have 1,923,426. Again, let's copy that at the beginning of year 4 and then multiply it with 13% effective rate. And we will get 250,045. And then, we have for this column, 2 million outstanding balance times 10% nominal rate, and we will get 200,000. So, the discount amortized is the difference of these two, and we will have 50,046. And then, the ending balance will be 1,923,426 plus 50,045 minus 1 million, and we will have 973,471. And for the year 5, let's copy this 973,471 and then multiply it again with 13%, and we will get 126,551. And for the third column, we still have 10% nominal rate or agreed rate times the final undiscounted unpaid principal of 1 million, and we will have 100,000. So the discount amortized is 126,551 minus this 100,000, and we will have 226,551. So 26,551 plus the beginning balance minus this final 1 million, and we will have 22, which is the same with the results in the timeline technique. So that's how we make an amortization table. Okay? Now, let's end this episode to make this video short. So in the next episode, we will try to answer the 7 possible measurement questions again using this amortization table before we go to the accounting or the recording related questions. Okay? So, if you've learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. So, thank you for watching and see you on the next one.